Hey, welcome to the AltEdge framework. I'm Pedro, and this is the part 1, lesson 1, how the crypto market really works in 2026. The first part is completely free. I'm doing this because the market has kind of shifted. If you are a beginner, I want to make sure you don't get liquidated in your first week by following crypto gurus' advices. And if you are an experienced trader, I'm here to show you why the strategies that work in 2021 or 2024 are not as good in today's more institutional environment. And I want you to see the logic behind this framework first, so once you understand how the mechanics have changed, you can decide if you want to go deeper into the paid parts. So let's get into it. Let me ask you something real quick. How do you decide whether to go long or short? Like, actually, what's the process? What do you look at? What makes you pull the trigger? Just think about it for a second. If your answer is something like my indicator was oversold, price hit my support line, and I love this one, my favorite guy on Twitter posted a chart with an arrow pointing up, that's kind of a big problem. Not because those things can't work, sometimes they can, but because you have no idea why they work, and more importantly, you have no idea when they will stop working. Here is what most traders actually do. They learn some patterns from influencers, all of whom have never traded real money, maybe even from TikTok or Instagram reels. They draw some lines through on a couple of indicators and then hope. They hope price bounces off their line. They hope the indicator says it's time to buy. They hope the pattern plays out, and some of them get lucky, just like at a casino. Your first night can be great, but then when you have no real edge, it's just a matter of time. Some lose in weeks, some lucky ones, last a month or two, but at the ending, it's always the same story. So the reason is simple: they are trading without the context. They have no idea who is on the other side of their trade. They don't know how the other traders are positioned. They don't know why price is actually moving. They just reacting to lines on chart without understanding what's driving any of it. So what if you could actually see where traders are positioned right now? What if you could tell when one side of the market is over leveraged and about to get wiped? And what if you knew where the forced selling would happen before it happened? In crypto, basically, you can, unlike classic traditional finance, where this kind of data is locked behind expensive, usually terminals or delayed by a couple of minutes or hours, crypto derivatives gives you real time access to open interest, funding rates, liquidation data, order book depth, and so on. So most of it is completely free nowadays, and this data shows you exactly where the crowd is positioned, and crowd in crypto, they are wrong at exactly the worst moments. So this is the foundation of everything we will cover in this course. It's a two-step system. Step one is bias. You use spot and derivatives data to figure out which direction the market is likely to go, where is a new money flowing, in which side is over leverage, where will force liquidation happen. This is your edge, seeing what most traders can't. Step two is execution. Price action tells you when and how to enter. What's the exact level? Where does your trade idea die? What's your stop and where you should take profit? Data gives you a direction. Price action gives you timing. That's the double edge, or aka two possible scenarios. You need to go with two steps system most of the time. So let me show you what time looks like in practice. What this looks like in practice. Imagine a coin sitting near support after multi-day sell-off. You go on Twitter, everyone bearish. Usually we are going lower, or support will not hold. The usual doom and gloom, but then you open your data tools and the picture is completely different. Open interest, for example, flashing, that means that over leverage longs, the late buyers, they got forced out on the way down. The weak hands are gone, liquidations are spiking, longs are getting wiped, funding goes negative, shorts are now paying to stay in the positions, derivatives are trading below spot, and on the order book, for example, you can see bids stacking. Someone big is quietly absorbing all the panic selling. So the crowd is panicking, but the data is telling you the selling is exhausted, the over leveraged traders are gone, and yeah, someone with real size is buying here. So here you can see actual charts. This is what I said before. This is a BTC setup, clean data, clear signals where the data line up like this. The bounces was sharp and it held. This is altcoin setup, kind of same type of data signals, but the result is kind of different. You can see the bounce happen, but it was messier and more volatile wicks everywhere. So overall weakish. This is something we will dig into a lot in this course. So BTC and alts behave very differently, as you can see, and your approach needs to account for that. So you can see here on the BTC chart, this is pretty simple explanation of the trade. This is the last base before the expansion move. You can see the last base before the expansion higher. So this is the key area. You can draw some box and overextend it to the right place. Also, you can see how over leveraged longs pile into the high prices. You can see lots of short liquidations liquidated on the way up. It's mostly used as a fuel. And yeah, funding flip-flop from positive to negative territory, nothing really crucial. Then you can see, if you set your limit orders here, you can see how price action slowly decreasing, and hand in hand over leverage longs are slowly getting out. It is mostly over leverage longs are liquidated on the way down, aka they are not, it's usually not their choice, but they are mostly liquidated on because they are usually buying the stop and they are hoping for, I don't know what type of prices, or they are usually breakout traders and impatience and or whatever. But the real confluence comes here. Even if you step here in the first touch of the box, you can see how price starting to slow down. Heavy negative funding, which means that spot is trading usually above the per price, or market is purely shorted, but this is the first case and in this scenario. And yeah, you can see overall longs are slowly getting out. You can see these yellow lines. These are limit bits. Usually you can see it in heat maps. So this is mostly spot or perp. Spots are a heavier hand, so you can see how price react, just filled here, front run here, filled here, and how market structure break, and we slowly retrace and go in our way. So limit bit stacking absorbing all the panic selling and support. So this is the really clean example. BTC setup, very clean. You can also take these trades if you will know how this works and what you should do in this situation. And on the other hand, this is the altcoin setup, different result, the same base, expansive move higher. You can see how price almost retraces the candle, but full candles, but then again slowly drift higher in mostly fill of the wick. Leverage stepped in, the same situation like here in the BTC, then slow decrease, but you can see in BTC the decrease was almost on the beginning of the starting point, but here the decrease is not so deep or as in BTC, so it's kind of more shallow, but you can see price touch the last base, negative funding. Also there this situation will be more about the more aggressive shorting, also, or market makers, some as hedging or whatever, but here you can see price react, and first trouble area again rotate back down and go through this box, and the price did another -7 from your entry base, plus some slippage, of course, so you are basically cooked on your account, I would say. Yeah, this is the data dashboard. You can see this on, for example, Velo chart. This is a simple dashboard where you can see open interest, funding, price changes, and some interesting data. So the execution, but you don't just jump in because the data looks good. That's not how this works. You wait for price action confirmation, a failed swing at the lows or break in market structure. where the sellers clearly lose control. And then you enter long, stop goes below the swing low, as you can see here, tight on BTC, where wicks are cleaner, wider on low cap alts, where you will get hunted otherwise. Target first area on resistance above range high, usually previous structure, or you will recognize it pretty simply when you will know how to read the market structure. And if the data is really screaming the structure is clean, you let it run. So the market bounces hard. You bought when everyone was selling, not because you were brave, but because you had data telling you the sellers were done and buyers were stepping in. Basically, this example is the entry situation on lower time frames. I thought that this is this explanation on BTC, and you can see here on lower time frames, this is the base, origin of the base. You can either step in, but then you will see that you will be kind of in a drawdown a couple of hours, and then price starting to build this mean reversion. But this is the classic entry setup what I'm using most of the time. It's failed sync. You can see it's finished. It's finished here. You took this stops, price action close like this bullish hammer candle, break of market structure here. Price again kind of retrace into the base, retail structure, and step into the long. So pretty simply. Pretty simple setup, execution setup. And yeah, that is what it looked like. The data called it, the price action confirmed it, clear entry, clear stop, logical target. That's the framework in the action. And so why does this work? You are not guessing, you are not drawing lines and hoping, you are reading where people are actually positioned and you are trading against them. When the data says that they are wrong, you are buying when overall traders are forced to sell. You are providing liquidity when everyone else is panicking, and here is the thing, there is general risk premium in these trades. The market literally pays you for being willing to take the other side of force low, so that uncomfortable feeling of buying into a sharp drop, that discomfort, exactly why the edge exists. If it felt comfortable, everyone would do it and the edge would disappear. So isn't a secret indicator. It's not a magic pattern, it's framework. Data gives you, as I said, bias, price action gives you execution, and once you see markets this way, you can't unsee it. So yeah, this is the course overview. We will go deep on price action for execution levels, entries, and where to put your stops. Then we will cover the derivatives data in detail, open interest, funding, liquidation, and order book depth. After that, we hit module 4, market microstructure. This is where we look under the surface, and I have something more kind of special. My colleague Wojta is joining us for a series of mini lessons. He is going to completely deconstruct his 2026 altcoin strategy and show you exactly how to use the Cartel scanner, a tool that we will be available to you to spot big moves before they happen. And finally, we will see tie it all together with the complete daily workflow and risk management. Everything builds on what you are about to see in this kind of free lesson. So, stops trading blind. That's the core of everything we do. As I said, this module 1 is completely free, no strings attached, no credit card, nothing. I want you to have the foundation first. It's enough for you to decide if this entire framework is the right fit. And yeah, let's get into it.